All right, let's get right into it. Every single investor, I don't care if you're just starting out or you've been doing this for decades, you face this one big question. Do you just consistently, systematically put your money to work like clockwork? Or do you wait? Do you hold on to your cash and try to find that perfect moment to jump in? Well, today, we're putting those two big ideas head to head. I mean, this is it, right? This is the question everyone wants the answer to. When is the best time to invest? It's pretty much the whole reason we're doing this explainer. Is it better to just get your money in the market right now, or should you wait for a better shot tomorrow? Let's break down the two main philosophies that try to tackle this.
So let's break this down. On one side, you've got the steady investor. Picture a hiker just methodically putting one foot in front of the other. Rain or shine, they're investing the same amount of money on the same day every single month, no matter what the market's doing. Then you've got the market timer. This person's more like a hunter, you know? They're sitting in a blind, totally patient, just waiting for that perfect shot. Two totally different ways of thinking about this.
Okay, so let's start with that first approach, the steady path of dollar-cost averaging, or DCA for short. You've probably heard the saying that goes with it, and it's so important. It's all about time in the market, not timing the market. Let's unpack what that really means.
So what is DCA really? It's simple. You just decide on a fixed amount of money, let's say $500, and you invest it at the same time every single time, like on the first of every month. And here's the key. You do it no matter what. Market's up, you invest. Market's down, you invest. The whole point is to take the emotion and the guesswork out of it. It's just an automatic, methodical way to build your portfolio.
I absolutely love this quote from the legendary investor Benjamin Graham because it just nails the mindset. Buy your stocks like groceries, not perfume. Think about it. When you go grocery shopping, you're not agonizing over buying milk, right? It's just a regular habit, but perfume? That's a special, occasional, emotional purchase. DCA is all about making investing your boring, weekly grocery run.
All right, let's switch gears and talk about our other contender, buying the dip, or BTD. And let's be honest, this one just feels right, doesn't it? The whole idea of buying low, I mean, who doesn't love a good sale? It's so tempting.
So the strategy here is basically to hoard your cash and wait. You're just sitting on the sidelines until you see prices take a nosedive. The whole game is to swoop in and scoop up all those shares at a big discount, hoping to ride the wave back up when things recover.
But, and this is the million-dollar question for this strategy, how do you really know when you've hit the bottom? I mean, what even is a dip? Is it down 5%? 10%? What happens if you buy and it just keeps cratering? Or even worse, what if you wait for this big dip that never actually happens and you just watch the market climb and climb without you? Yeah, without a crystal ball, this gets really, really hard.
Okay, so we've talked about the philosophies, but talk is cheap, right? Let's look at the cold, hard data. This is where things get super interesting. We're going to pit these strategies against each other in the real world and see who actually wins.
Okay, let's set up the ultimate stress test here. We're going back to the 2008 financial crisis. Imagine two people. First, you have the unlucky investor. This person starts putting in $1,000 a month in July 2007, literally the worst possible time, right? Before the market completely implodes. Then you have the perfect timer. This person is a genius. They wait, they hold their cash, and they start investing that same $1,000 a month at the absolute perfect bottom in February 2009. So, who do you think has more money today? My money's on the perfect timer, right? Let's see.
And the results? Well, they are not what you'd expect. Our unlucky investor, the one who started at the absolute peak and just kept buying all the way down, ends up with around $247,000. And the perfect timer, the one who nailed the bottom, they have about $223,000. I know, it's wild.
Yeah, you're seeing that right. That's a $24,000 difference. The person who didn't try to be a hero and just stuck with the plan, even when it was absolutely terrifying, came out way ahead. So, how is that even possible? Well, think about it. As the market was crashing, they were automatically buying more and more shares for the same amount of money because prices were so low. They were loading up on cheap shares, which supercharged their returns when the market finally turned around. It's like they used the market's fear to their advantage without even thinking about it.
And look, that 2008 scenario, it wasn't just a weird one-off. A really detailed study looked at this over tons of different 40-year periods. And what it found is just mind-blowing. Even if the buy the dip person had a perfect crystal ball,
Like, they knew the exact bottom every single time. The regular old dollar-cost averaging strategy still came out on top more than 70% of the time. That is just incredible.
So why does this happen? Well, it all comes down to the cost of waiting. First off, while you're sitting there in cash, waiting for the sky to fall, the market is way more likely to just go up. You're missing out on gains, and missing out is a huge deal. Get this, if you miss just the 10 best days in the market over 20 years, your total returns can get cut in half. And finally, remember that perfect timer with the crystal ball? If they're just 2 months late to the party, just miss the bottom by a little bit, the DCA strategy suddenly wins 97% of the time. The odds are just not in the timer's favor.
Okay, here's another great study, this one from Charles Schwab, that really paints a picture. They created 5 imaginary investors and tracked them for 20 years. You've got Peter Perfect, the genius who somehow times the bottom every single year, Ashley Action, who just dumps all her money in on January 1st, Matthew Monthly, our trusty DCA guy. Then there's Rosie Rotten, who has the absolute worst luck and invests at the peak every year. And finally, Larry Linger, who just can't make a decision and stays in cash.
And this chart just says it all. So yeah, of course, Peter Perfect with his magic powers came out on top. But look at this, our DCA investor, Matthew Monthly, is right behind him. He got remarkably close to perfection just by being consistent. But here's the real lesson. Look at the massive gap between everyone who invested, even the person with the worst timing, and Larry Linger, who stayed in cash. He just got completely left behind. Turns out the biggest risk wasn't bad timing, it was not participating at all.
All right, so the data seems pretty clear, right? Being in the market is way better than trying to time it from the sidelines. But does that mean we just set it and forget it completely? Well, maybe not. Let's talk about a smarter way forward, a way to combine that discipline with a little bit of opportunity. So here's the verdict. For most of us, for the vast majority of investors out there, dollar cost averaging is hands down the better path. It's just more reliable. It takes all that stress and anxiety of trying to guess the future off the table. And most importantly, it keeps your money in the game, working for you. And that's what really matters, because the best strategy in the world is useless if you can't actually stick with it when things get scary. But okay, what if you want to get a little more advanced? You can try a kind of hybrid strategy. Here's how it works. Step 1 is your foundation. You never, ever stop your regular, consistent DCA investments. That's non-negotiable. But here's the twist. Step 2, when things feel frothy, when the market's been on a tear and everyone's super greedy, maybe you dial back your investment by, say, 25% and you just stash that extra cash. Then, step 3, when the fear kicks in and the market takes a real dive, that's when you deploy that cash you saved up on top of your regular monthly investment. It lets you be a little greedy when others are fearful, but without abandoning the discipline that we know works. And really, that brings us to the final question you should ask yourself. Is your own strategy built on discipline, or are you secretly waiting for a crystal ball to tell you what to do? The data is pretty overwhelming here. A boring, disciplined process almost always beats a genius trying to make the perfect call. So think about it. Are you building on a steady foundation, or are you just waiting on the sidelines for a magic moment that might never show up? Because at the end of the day, the best strategy isn't the most complicated one, it's the one you'll actually stick to.